Mark, let's get back into the markets conversation, but I do want to pick up from where Jinshan left off. This lockdown, another massive city in China going under a lockdown. I'm wondering how we evaluate the story in terms of risk to the global market, because of course previously all we could talk about was China lockdowns and the risk that laid in there.
So, look, there's been a lot of debate internally around this, around the impact. I think that there's a couple of different ways to look at it. First of all, we always knew this was a possibility with COVID-0 lockdowns. And in many ways, the kind of sequences of lockdowns that we feared after Shanghai earlier this summer hasn't really transpired. So I guess there's been a bit of a gap. It's actually seemed like being better than we expected, fewer lockdowns. But now this is a reminder that China hasn't abandoned its COVID-0 policy. So you can kind of go, well, it's what we always expected, not too big a news. On the other hand, it's a bit of a reminder that it's still bleak, their policy, for the global economy. Now, in terms of that, it is the headquarters for many businesses, but one of our colleagues, April Ma, has done a great point saying it's generally smaller businesses. It's not the headquarters for big businesses like in Shanghai. And while it's a very important conduit in southwest China, it's the capital Sichuan province and it's that kind of gateway there, it is for those kind of smaller businesses, and it won't have the kind of massive impact that it did on a Shanghai lockdown. So at the moment so far, for stock markets, they're kind of shrugging this off, kind of always knew it would be a risk, but it is a hit for the global economy, and that's why you're going to see commodities stay soggy, and it might continue to put pressure on the yuan, which has been under pressure anyway.
Yeah, but then I kind of do this acrobatics of the mind to be like, okay, so China lockdowns, that pushes down commodities, but lower commodities means lower inflation, which means risk assets could rally.
Look, ultimately, that will ease the kind of headline inflation stuff, but you've got to remember that, like, if you're going to rely on commodities to bring down inflation, you need just a major collapse, because the whole point is our inflation problem has moved way beyond commodities. This was a supply-side inflation problem, but it's not anymore. Particularly in the US, it's very much an inflation that is in wages, it's in rents, it's in services, it's in all those sticky components that are nothing to do with commodities. So really, just to get inflation down to target, you need commodities to absolutely collapse back to levels we haven't seen any time this year to kind of provide that relief. So I think people are mistaken to focus on commodities being the relief to inflation. They can make it worse, they can help at the margin, but they're not going to solve it.
That's fair enough, especially when you have Fed presidents continue to come out, reinforce the message from Powell that, as Mester said, they're not going to cut next year. And so one of the other contrarian things, Mark, people have told us, of course, is the other side of the euro story is that perhaps it's peak dollar. I don't see how we can have peak dollar when you're looking at yields that continue to gain, and you have yen, for example, it just hit a 24-year low.
Look, I'm with you, Danny. I mean, in terms that I sympathise with the idea that at some point we're going to reach a long-term turning point in the dollar. This cycle will see the high in the dollar forevermore. It's an expensive currency. It's all priced. The world's structurally overweight the dollar. However, it's too early to fight that trade. I think we'll see fresh highs for the dollar over the next 3 months, over the next 6 months.